The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Live Beginner's Course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Hello, good morning, and welcome to the Live Beginners Trading Course here with Forex.Academy. My name is Robert Blackwell, and I am the host for this beginners course. We are now approaching webinar 2, and within this webinar, we'll be discussing, guys, what's all the fuss about? Let's get into trading these financial markets. Let's discuss some of the objectives that we have as traders and outline really how we look at price action, what is a price chart, and go through some analysis, early analysis, albeit at this stage, just to really give us a full perspective of how to look to actually approach these financial markets and approach the education over the next 2 weeks. Before we do so, we have a disclaimer. Of course, there is risk involved trading the financial market, so please be aware of the risks. Take them into concern, of course, and try and manage your risk as well as possible. And then with each live webinar, of course, just a few pieces of housekeeping before we do begin. Feel free to ask questions throughout, guys. It's a totally live interactive webinar, so I would imagine most of you guys are, of course, beginners on a beginner's trading course here. Guys, use me, use all the experience we have here at Forex.Academy. If you have questions throughout, you have a chat box there located on the right-hand side of your screen there. You can, of course, chat with me there, and I'll be able to correspond, answer your questions throughout. The live webinar is being recorded and will be placed into your members area once we have concluded. So for revision purposes, of course, you'll have each webinar there throughout the series to revise. And we have a Q&A session at the end of each live webinar to deal with some of the main topics, issues, and questions from our students. Again, just on our course overview, to recap, we discussed the objectives of financial trading in the first beginner's course lesson there, webinar 1 yesterday. We really discussed our role, our agenda as a retail trader within a very, very complex trading environment. We looked at the different products we trade, i.e. financial derivatives. What we like to trade is, well, our preferable financial derivative is, of course, the contract for difference, because we can simply speculate on price, the movement of price, without actually physically owning any asset we trade. We looked at some asset classes, so we can trade Bitcoin, we can trade commodities like oil, gold, silver, cotton, sugar. We can trade Forex pairs, we can trade equity indices and equity single stocks, bond markets. So there's a whole plethora of different markets to trade from. And then we finish off with, well, when to trade. There's no right or wrong answer to understand this question. It's all about identifying opportunity. That brings us on to today's lesson, of course. We're going to discuss what is all the fuss about. So what is price action? What is the financial markets? We define it as a battle for price, of course. Japanese candlesticks are those depictions of price movement. We'll discuss both buying and selling opportunities. So if you were not aware, of course, financial trading is simply more than trying to buy an asset, hoping that price appreciates or gets higher or increases, and selling it at a better price. No, we can certainly look for selling opportunities by short selling the market and making profit when the market moves to the downside. So we'll look at that. We'll look at trading different time periods, momentum and direction, and market sentiment as well. And then we'll go through the essential knowledge before going on to the trading practical workshop with the final lesson Thursday this week. So look forward to the practical trading workshop. It's a great, enjoyable lesson, and it starts to put some of these skills together practically on the trading platform. With today's specific lesson outline, we will be looking at the battlefield, discussing price action and the Japanese candlestick structures, understanding Japanese candlesticks inside out. So within their own structures of price action, they actually provide signals to forward or future price movement. Buying, which is going long, and selling, which is going short. Trading with different time periods, momentum and direction, identifying trends, and finishing off with market sentiment again. So let's jump into describing the battlefield. Really, it's price action, guys. This is what we're looking to trade. To simplify market interaction, we often describe the marketplace, so absolutely any market that you wish to trade, as a constant battle between the bulls, which are the buyers in the market, and the bears, which are the sellers. Okay, so you might have seen this bull here on Wall Street. You know, it's a very famous statue on Wall Street there. It signifies bullish market activity or a market bull. That's when we're in effectively rising prices across assets. Both provide a good analogy as to represent movement, the movement of a market participants. Okay, so bulls, if you think about a bull, when it attacks, guys, it attacks driving with an upward force and bears with a downward force. That is why we call them bulls and bears. Markets are therefore said to be bullish when prices are increasing and bearish when prices are decreasing. Bullish or bearish price action over a prolonged period of time will then feed into the market's overall view of the current market sentiment. And then, of course, we can look at market trends, which we'll do throughout the few webinars here. So we describe this as a battlefield, guys. So this is effectively, for some of us, perhaps the first time we've seen a price chart ranging from left to right. So we have the price, of course, and the date. What do we think, guys? How would you describe this price action? Is it bullish or bearish activity? Is it bullish or bearish activity? Well, we would describe this as a trend, an upwards trend. It is, of course, bullish activity. Very good. So bullish activity, guys, when a trend is moving to the upside, and obviously adversely when a trend is trading to the downside, well, we call this bearish activity or a bearish trend. So let's try and move on. Price action itself. So just to really result, I'll just show you back this chart again. Effectively, this chart is our price action chart. Okay, this is our price action chart. This is what we look to trade each and every day. As traders, we are only able to profit from the movement of price. The more prices move up and down, the more volatile the market is said to be. Okay, so that's respectively called volatility. But ultimately, welcome it as it is, in fact, the cause for opportunity. So we respect volatility because the greater inference or movement of price, the more short-term risk there is in the market, especially if you're trading short-term. But we call this volatility and we respect it, but we welcome it because it causes opportunity for us. As market sentiment shifts, the price of a security will move accordingly. We assume as traders that markets are efficient and that all available news is reflected in the constant movement of price in each market. As news becomes available, new price change is again realized. So if you have ever studied economics, guys, we call that efficient market hypothesis. The fact that all available news is reflected in the price. Okay, all available news is perfectly reflected in the price, and we trade the price. The Forex markets are perhaps the best model to express this ideology, given they have an unquantifiable amount of variables that affect price and experience a lot of volatility. So you may have heard, the Forex markets, how do we trade them? There's a lot of volatility in there. Guys, volatility is a good thing, but it's all about choosing your trade size so that you're not overcompensating in risk, so that you're not feeling the pressure on any trade, and you're looking to get involved in this volatility in these Forex markets, say for example, where you'll possibly have 10 trades, 6 or 7 of them will be a winner, 3 or 4 of them will be a loser, and you'll gain overall. That is, of course, the ideology of trading. So how can we profit? Okay, how can we profit in these markets? We're able to speculate on the future movement of price. Okay, so this is what we do as traders. We can profit from a price increase by taking a long position. So when you buy a market, guys, that is known as taking a long position. So you can say, well, I bought the oil market at 61.50. You're effectively long the oil market at 61.50. Okay, so when you hear traders talk about those positions, that's what they're referring to. Alternatively, we can profit from a price decrease by taking a short position. So that is the one benefit to us as CFD traders. Again, the financial preferred derivative that we trade, the CFD, the contract for difference. Why is that? Well, because we can speculate on these price movements without owning something, without owning the instrument. Otherwise, let's use a financial institution to assimilate how they take short positions at times. If they believe the price of an asset is going to go down, they effectively lend or borrow the asset. Okay, so they might share contracts between financial institutions. Perhaps if they believe a Forex market is going to move to the downside, they will request short-term money from what is that? There's a large counterparty bank called Citigroup. You may have heard of them. That is what they do, of course. They lend interbank exchange, of course. So one bank might look to take a short position, let's say in the euro dollar. So then they'll go to a bank like an interbank lending association like Citibank, request 200 million euros, of course, and take a position in that market. When the market goes down, of course, they'll effectively provide the 200 million euros back with a small interest, and actually look to make profit on their trade, of course, keeping the profits. That is not what we do in the Forex markets, guys. We don't need to own the asset before we look to take a short position. Effectively, we can sell something without owning it. Now, I know that might sound strange to some of us, but it's simply a contract on the price, the differential on the price. When we take a short position, okay, and the market moves down, when we want to take profit, we simply give that back to the market. We, sell the contract itself, the short contract, back into the market. Therefore, it effectively goes in as a bid order, and we get out of that trade, so we exit that trade. So when we take on a contract, we have assumed one contract. When we're finished with that contract, we give the contract back into the market or back into the liquidity pool, and we are now taking profit on the trade. We don't need to own any barrels of oil or any yards of cotton or anything like that. Okay, so that is how we look to trade these markets, and this is how we analyze the markets. Of course, we look at Japanese candlesticks. So this is going to be a lesson, guys, that you're going to want to revise, because there's a lot of information here and it's going to help you so much over the long run if you can take this on board. So we have two candlesticks here. What we have is a bullish candlestick and a bearish candlestick. These are the highs of the candlesticks, okay? So the highest point in each candlestick is the high of the day. So if this is the oil market here, and I'll just draw on the right hand side, let's say this is the oil market, we open at $65, dead even, okay? Sorry, this would be the opening price, so $75 here for our bearish candle. Okay, we open at this price, the market trades down, but this might be the high of the candle, so this might be 75, 80, let's say. Okay, and alternatively, this is the low of the candlestick, so this might be 60, 420. Okay, and this is the trading range in between. This is the body of the candle in here, but we'll go through this in a lot of detail. So there we have our low of the candle, and again, let's just consult the bullish candlestick first of all. So the bullish candlestick, what does it present to us, guys, if it's bullish? Absolutely, Philip, absolutely. It represents that it's a strong trading day. It opens at this price here. During the course of the day, it of course may trade up down to the low and down to the up to the high, but effectively it trades up and actually closes at this price. Okay. Alternatively, we have the bearish candlestick. It opens here at this price. It trades throughout the day and it closes at the price there. The body itself represents the difference between the opening and the closing price of the candle. The candle is bullish when the closing price is higher, and adversely then we see the wicks here. So this is the type of trading that you might see in here, guys. These wicks simply resemble that the market traded at some given time this price. So let's just use our bearish candlestick for example. Well, where did we start, guys? We start with the opening price here. Now at any given point there is a volatility in this market. At any given point, guys, let's say this market traded, so this could be the course of the day. It opens here at this price here, then it trades down a bit, then some volatility causes it to trade up through the highs, trades up to this high, then it of course trades down again right to the low, to our low here, and then with some pullback it retraces and closes at our close price. So that could be a simple day in the life of a candlestick. Okay, so you can see that there's opportunity in this volatility, but again, you're looking to use the candlestick itself as a signal, and obviously with this candlestick it is a sell signal given that it's a bearish candlestick. So we've seen two candlesticks where we see two strong bodies of the candlestick, one indicating a bullish and one indicating a bearish candle itself. What will the candlestick look like if the day is neither bullish nor bearish? And this is what we have in front of us. We have the opening and closing price at the same price. Okay, there is no body to the candle as the market closes at the same price it opens. This is not to say that the market did not trade up or down during the trading period, simply that the market experienced volatility and closed at the opening price. Okay, and that is indicative, guys, of volatility in a candlestick that shows us some indecision. And again, I'd like to highlight, this is not to say that the market did not trade up or down, because, well, did it, guys? Did this candle trade up or down? Philomena says yes, it was quite volatile. That's absolutely correct, Philomena, because it traded at one stage to the upside, it then reversed and potentially traded to the downside. It might have seen some more volatility, traded to the downside again, and then closed right at the opening price. That is effectively how potentially that market could have traded. So there was volatility in there, and we can see that with the wicks of the candlesticks with the highs and lows. Again, the question I would like to ask here, just when I leave this doji candlestick here, what sentiment may this candle reflect in the market? And the answer is indecision, because the market has traded with some volatility. It literally is not either bullish nor bearish. It's showing us some indecision. Okay, so that's just one thing to note, guys. And don't worry, you get an opportunity to revise this in your members login area as we go through all of these Japanese candlesticks. So let's delve into understanding more about these Japanese candlesticks. Guiding principles, guys. Okay, so all known information is reflected in the price. That is a given. The what is more important than the why. A visual representation of price fluctuation, that is inevitably what a candlestick is, and that the actual price may not reflect the underlying value and irrationality is to be accepted. Now, this does not contradict guiding principle number one there, where all known information is reflected in the price. Simply that, of course, the markets not only trade because of fundamentals or technical aspects, they trade because, well, it's a psychological function in the financial markets. They can often be irrational, just like consumers or any economic agent can be. They can move with total unawareness to how, underlying principles may react to the market in the short term. And you've seen this, guys. You've of course seen this in bubble speculations. Let's use Bitcoin as an example there, all but 5 months ago. Something that was trading up from 2,000 to 5,000 to 10,000 to a high of around 20,000 US dollars in a very short space of time, before retracing the whole way to 8,000, $6,000 there around. So there's a level of exuberance there. There's a level of market euphoria. There's a level of irrationality behind that market, that trading. So we know that we take it as a given that we trade what we see. We look at the price. It's a visual representation of that price. All the information at that time is reflected in the price, and that information may also be human sentiment or human irrationality, but we accept it. Okay, that is simply how we trade price action. And again, I'll leave you with a quote here because it is very, very prominent. It is actually from, well, you may have seen him from your economists' economic textbooks, of course. John Maynard Keynes, the father of many, many different economic studies. The markets can remain irrational longer than you can remain solvent. A very, very famous quote from him, and that is evidently the case. Just think about that quote for a moment, guys. The markets can remain irrational longer than you can remain solvent. So that is why we never place all of our account on one trade, even if we have such a level of conviction that the market is going to trade up. Let's say the European Central Bank announced that the markets are very, very strong, that they've done their study, that unemployment is super, that we are going to see, of course, a lot of growth over the next 3 months. For whatever reason, they have a whole list of reasons, and we see the markets open at 8 o'clock in the morning and trade down very strongly. Well, perhaps the markets are pricing in something totally irrational, but the fact that the markets are moving that way, we need to price in that irrationality as well, because they can trade irrationally more than we can remain solvent on our account, of course. So bear that in mind. Price action aims to study the price charting, and that is what we look at. We look at the price charts. Traders must study the price action of candlesticks when making informed decisions. In each candlestick, it is important to focus on what has actually happened, i.e., the reaction of traders within the trading time period. If a market trades up very strongly during the course of the morning, only to reverse and finish with a bearish gravestone candle, then the market is weak. And again, we're going to go through a lot of these candlesticks just now. It is telling us that buying power has been rejected and sellers are forcing the price down and winning the battle. Do you remember I discussed this at the very start of the lesson as a battle for price? This is our answer, guys. This is how we trade price action. Who is winning the battle? And if we can answer that, we can subjectively or objectively have a better idea to where to trade these markets, okay? Understanding the concept of price action within candlesticks is key to assessing what happens next, okay? Again, what are we trading, guys? Well, we're making assumptions on future price movement. How can we better supplement our decision making towards where the market is going to move to so we can profit? Okay, so what happens next in answering that question will give us that insight. So let us delve into many of these Japanese candlesticks, and please stop me and ask questions throughout. Okay, so we have an engulfing Marubozu candle. Large trading range. This is what you can see here, guys. So basically, we have the closing price here with the bullish, opening price below, trading the whole way up, closing at the high of the price. So it opens at the low price of the day and closes right at the very high of the day. And adversely, the bearish engulfing Marubozu candle opens at a price, which inevitably turns out to be the high price of that candle, then trades the whole way down, closing on the lowest price of the day. Okay, so that is our engulfing candle. What does it present to us as a signal? Well, we see a large trading range reflecting a substantial market move. We see the trading range will outweigh the previous price action range. So if we have 3 to 4 candles before this, they might be rather small in terms of the range of this candlestick or the size. The candle has clear directional bias. Now, does that make sense? It has clear directional bias. Of course it does. It doesn't look to pull back or retrace. It's telling us the market simply wants to trade one way. The mere fact the candle closes on the high low of the day is truly significant. There's no opportunities for buyers or sellers to effectively try and push this back and win any battle at all here. Okay, so very, very significant for us. Here we have a bullish hammer candle. And again, what does it represent? Well, we can see the closing price is the high price of the day. So that's very strong for us. Okay, great. Opening price is there. Okay, and we see a very large wick in this candle. Again, what does it represent? Well, the buyers are winning the battle. The market witnesses a reversal within the trading period, signals a rejection to the downside. Buyers willing to rebuy the market, of course, and it closes on the high of the day. So very, very technically significant for us. Now, if we look and pay some attention to the wick here, the wick could experience an unlimited number of trading patterns before trading and closing past the opening price. And that is effectively what we see here. So what you could see, guys, I'm just going to draw this in a little detail. Hypothetically, what you could see is, the market trade down like this. Then let's use a different color just to suggest. It may look to show perhaps what we would call an engulfing Marubozu there. And then it would trade up through the course of the day. It may look to, of course, reverse that price action. And then, of course, it may look to trade up right to where we are again. Okay, so closing on the high price. So a lot of volatility in there, but effectively this is showing us a very strong signal because we get the close right at the high. It's rejected all this selling material here. All these sellers trying to push, they have been rejected, and we close right up at the high. So very, very significant in terms of forcing bullish activity. Well, the inverted hammer now, this is the opposite almost. What do we see? Well, we see the wick again experiencing an unlimited number of trading patterns, but this time it's closing just below or just above the opening price. So effectively, this doesn't give us a very strong bullish signal. Buyers are struggling to win the battle. The market is experiencing real difficulty trading up, signals a rejection to the upside. Okay, and evidently a rejection to the upside now. Although this is of course a bullish candlestick, because we define this as bullish because we have the opening here and well, it closes at a higher price. Okay, right here, but it traded the whole way up and was rejected. So because the size of this candlestick is quite significant, it is rejected more than it actually trades up or closes at. So there is uncertainty for long positions. Okay, so it is a bit of a signal to showing a rejection to the upside, and closes close to the opening price as well. So the market has tried to trade up but has been rejected again. Our spinning top candles as well. Now we have two very similar ones, of course. One is bullish and one is bearish, but they signal something quite unique to us. There's some strength weakness, likely due to continuation, but neither buyers or sellers are outperforming. Candles often represent small trading range and low volatility, no directional bias, signals a wait and see moment for the market. However, it's not necessarily a doji candlestick, which we'll discuss next. What I would suggest, guys, in trading these is it can be a little bit of a confirmation signal. So let's say we have the previous price action. I'll use 3 candlesticks here just to describe what I mean. Okay, so let's say we have these 3 candlesticks here. So we have 1, 2, 3 bullish candlesticks, and then we get our 4th bullish candlestick. Okay, it does highlight a little indecision to us, but we see that it doesn't outperform, but it does show continuation. So if we see this here, guys, and we're thinking, well, what should we do? Should we look to take profit if we're long from price 1 here, say at this price here? If we're long here and we effectively are at this price right now, should we look to take profit? Well, it's still a buy signal. It's still showing continuation to the upside, and you might get effectively 2 or 3 of these candles in a row in an uptrend. So again, that you might get 1 and then 2 and then 3 of very similar candlesticks. So you may miss out on this opportunity. It's not something necessarily to look to, it's not a buy signal to look to buy the market at price here or here, but evidently it does show that continuation. And the same is to be said for the bearish spinning top. Okay, although do bear in mind there is some indecision there, but it is different in terms of providing that signal. More of the indecision is provided with our doji candlestick here. Okay, so we have 1 and 2, and they're both doji candlesticks, and it's very important to point out, but they're quite different in their appreciative signal. Okay, why might that be? Well, the battle can only be expressed by the trading range of the market. That is the main difference. So which candlestick shows much more volatility? Okay, which candlestick here, 1 or 2, shows more volatility? It is of course candlestick number 2 here. Okay, we can assume doji 2 was more volatile battle when, and that perhaps the next trading period may be more explosive. Okay, both of these candlesticks show uncertainty. However, when we see this, we often see something quite significant in terms of long-term trends. If we have a long-term trend and have something like this, there's no volatility. So the volatility is leaving the market, let's say, we could argue as a signal, and there is no direction in price. So we call that a death star actually for a long-term bullish trend. But that's just some trader slogan or jargon to get in there. Just if you ever see it in the market, you'll be able to point that out. It just means that there's a likelihood of a reversal when we have a very bullish, strong period. Perhaps, let's say, the market trades up for 3 or 4 months and witnesses this candle. Then we can say, well, is this the end of the bull run? Whereas candle 2, it shows us much more volatility. Then if we think that the trend is going to continue, of course, to the upside. There's more likely to be a very, very explosive move in the next candlestick, just because it's seen a lot of volatility in the previous candlestick if we get that confirmation. Okay, so do be aware of the differences between our doji candlesticks. But of course, they both represent market uncertainty. What's going to happen next? Okay,